With a career spanning over 2 decades, Relli brings to the table a wealth of experience in banking, wealth management and financial services. Previously, he has worked with ICICI Bank and Centurion Bank of Punjab. Relli is a qualified chartered accountant and has also studied at the prestigious Indian Institute of Management, Bangalore. OMCs have already started feeling the heat of rising crude prices. The jump in Brent crude price has been a key external economic event, making many sit up and take notice across the globe, more so in India, over the last few months. Sanctions on Iran. President Donald Trump's decision to walk away from the Iranian nuclear deal could spur risks of sanctions, regional military skirmishes and attempts of a change of guard in Iran. As the country has influence in Iraq, Syria, Lebanon and Yemen, this could lead to a major regional conflict. Given the prevailing tight supply-demand situation in the oil market, the return of sanctions may cause a substantial upside risk to the spot price. With oil production in Venezuela declining and OPEC supply curbs continuing, shale production in the U.S. is rising too slowly to counter the supply squeeze. Higher oil price will add to inflation, eat into consumers' purchasing power and dent the fiscal on current account position of oil importing economies, including India. This, at a time when emerging markets are already under pressure, could worsen the situation for some oil importers in the second half of this year. Overdependence on crude oil, largely imported, crude oil consumption makes up nearly 29% of India's energy mix and has a 2.41% weight in the wholesale price index, WPI. India stands third in terms of crude consumption, which has grown at a CAGR of 2.9% over the last 4 years to FY17 and 5.3% in FY18. Despite such high usage levels, India stands 24th in the world in terms of crude production. India imports about 80 to 85% of its crude requirements and is the third largest importer in the world. A 10% hike in crude can increase the import bill by around 51,750 crore rupees, assuming FY17 volume imports, with the dollar at 66 rupees, and WPI will be pushed up by nearly 0.5%. Crude prices rallied to a 40-month high. Crude prices, which dipped to a low of $28 per barrel in January 2016, have now rebounded to the $77 level, last seen in November 2014. The rise can be attributed to global economies gaining growth momentum, OPEC's decision to cut output and pour oil production in the U.S. owing to environmental hits, cyclones, with the latest Iran sanctions being the last straw. Scary macroeconomic repercussions. It is a known fact that, with rising crude prices, inflation in the economy worsens, given higher prices of all major components of WPI. To mitigate this risk, the central bank could resort to hiking interest rates, which dampens growth sentiment. Further, with crude imports having a major share in the total imports of the country, the current account deficit (CAD) of the economy widens. Consequently, the fiscal deficit is affected. Thus, as a whole, for a crude importing country like India, a price rise is a key risk, reducing its ability to grow at its potential rate. Earnings impact on Nifty, Sensex. The recent sharp depreciation of the rupee versus the dollar and continued strength in commodity prices, however, may support FY19 net profit of Indian corporates. Sectoral impact of a pricey crude ** OMCs. Further, with elections around the corner, there is a fear that the price rise by OMCs may be halted till the polls are over. Oil exploration companies. Oil exploration companies may experience good profit growth with rising crude prices unless the government freezes crude realizations for explorers to compensate the OMCs. Asterisk Airlines, the inability to swiftly pass on the increase in aviation turbine fuel prices, nearly 30 to 35% of the total expenditure, that are dependent on crude prices, on account of high competition in the industry, may lead to reduced profitability in this sector. Asterisk Paints, dyes and dye intermediates. Asterisk Information technology, the IT industry derives orders from various oil-rich OPEC countries for technology. Further, exporting IT companies are expected to benefit further from a weakening rupee, which is one of the consequences of increased crude prices. Asterisk Cement, transportation and power costs account for about 20% of the total expenses in this sector. An increase in these costs, which is not matched with higher sales realizations, would result in reduced profitability. Asterisk FMCG, petroleum derivatives form the raw material needed for packaging items such as tubes, bottles and covers. Increased inflation may lower the demand for FMCG companies' products, with reduced purchasing power in the economy. Asterisk Automobiles. Asterisk Banking and finance, with oil prices headed north, inflation control measures, an expanding CAD and fiscal deficit, and rate hikes by the central bank are possibilities. Rising NPAs may become a reality for underperforming companies in adversely impacted sectors. Disclaimer: the opinions expressed in this column are that of the writer. The facts and opinions expressed here do not reflect the views of www.economictimes.com. Commenting feature is disabled in your country, region.